The strangest thing about buying a house a century ago was not the house, it was the day the mortgage ended. A modern buyer can sign one loan, make the same scheduled payment for 30 years, and watch the balance slowly disappear. In the 1920s, many buyers faced a very different bargain. They might need half the price in cash, borrow the rest for only 5 or 10 years, pay mostly interest, and then owe a huge final balance all at once. The loan did not gently carry a family from purchase to ownership, it carried them to another deadline. That difference changes the meaning of home ownership. Today, the 30-year mortgage feels almost like a law of nature, as if houses have always been purchased by stretching the cost across most of a working life. But that contract is a historical invention supported by insurance, regulation, national capital markets, and the federal government. Before those institutions existed, buying a home was less like setting up a long payment plan and more like placing a highly leveraged bet that money would still be available when the balloon payment arrived. Consider a purely hypothetical example based on terms many buyers encountered. A house costs $4,000. The buyer brings $2,000, an enormous amount for an ordinary household to save, and a local lender supplies the other $2,000 on a 5-year note at 6%. If payments cover only interest, the monthly bill is just $10. Over 5 years, the family pays $600, but on the final date, it still owes the entire $2,000. The lender does not ask for one more $10 payment. The lender asks for $2,000 at once. The family has only a few ways out. It can somehow save the entire sum. It can sell the property. Or, most commonly, it can persuade a lender to write a new mortgage and use that money to pay off the old one. Refinancing is treated not as an optional financial maneuver, but as part of the basic design. As long as employment is steady, property values hold, and local credit remains available, the arrangement can appear to work. Yet, the household never fully controls the most important moment. Its future depends on the willingness of somebody else to lend again. This is why the old mortgage was not simply a shorter version of the modern mortgage. It placed the risk in a different location. With a fully amortizing loan, every scheduled payment reduces the debt according to a plan until the final payment clears it. With an interest-only or lightly amortizing balloon loan, the borrower can pay faithfully and still reach the end owing almost everything. The calendar itself becomes a hazard. A family may be perfectly able to afford the monthly interest and still lose the house because the credit market is closed on one particular day. Why would anyone accept such terms? Lenders face risks of their own, and there was no single national mortgage system. Most home lending was local. A savings bank, insurance company, private investor, or neighborhood association guarded its own pool of funds. A 30-year promise looked dangerous. Depositors might want their money sooner, interest rates might rise, and inflation might erode fixed payments. A distant borrower was difficult to evaluate, and a house was difficult to sell quickly if the loan failed. A down payment of roughly half the property value created a thick cushion if prices fell. A short maturity also let the lender reconsider the bargain after a few years, renew it at new terms, or demand repayment. To the lender, this was caution. To the buyer, it meant that access depended on wealth before the purchase and continued access to credit afterward. The result was a patchwork rather than a system. Terms varied by city, institution, and borrower. Before national markets formed, mortgage rates could differ sharply by region. Money in a prosperous area did not automatically flow where families wanted homes, but savings were scarce. A borrower was buying into one town's liquidity, one lender's judgment, and one local economy. For households with substantial savings, the simplest route was a large cash payment and a modest first mortgage. Families might rely on relatives, inherit land, buy a cheap lot, or build in stages. Others layered debt because the first mortgage covered only part of the price. A costlier second loan could close the gap, but added another deadline. Every added piece made the household more fragile when income or credit changed. Another route ran through building and loan associations. These were local mutual organizations in which members accumulated shares or paid regular dues, creating a pool that could finance homes for other members. Their exact methods changed across places and over time, but the central idea was powerful. People who did not possess a fortune individually could save together and lend to one another. By the late 1920s, thousands of these associations served millions of members, making them a major bridge between household savings and household ownership. Building and loans could offer friendlier paths than short balloon mortgages. Some loans reduced principal over time, and regular dues turned saving into a routine. But the arrangements could be complicated. Borrowers might be members, shareholders, and debtors at once. Fees, premiums, share values, and maturity rules were not always easy to compare. Because the associations were local, a community collapse could weaken both sides of the same balance sheet, savers and borrowers. Still, they reveal an important truth. Ordinary Americans wanted long-term, gradual home finance long before the modern 30-year loan became standard. The obstacle was not a lack of desire to own. It was the difficulty of building a contract that households could afford and lenders would trust. In 1890, only a little more than a third of non-farm households owned their homes. By 1930, the share was around 46%, an impressive rise, but still less than half. Home ownership was common enough to shape the national ideal and restricted enough to remain beyond many families. The large down payment was one barrier. Imagine saving 50% of a house price while paying rent. A household with property, family wealth, or high income had an enormous advantage. One starting with nothing faced a loop. It needed wealth to buy the asset that might help it build wealth. Even after clearing that hurdle, the short loan created another. Instead of one road from debt to equity, the family crossed narrow bridges, each refinancing dependent on conditions it could not predict. During the prosperous 1920s, those bridges looked sturdier than they were. Construction, expanding cities, and available credit encouraged confidence. A near-term maturity did not alarm people expecting renewal. The final balance rolled into a new loan, even though principal had barely fallen. Refinancing-based finance can disguise a solvency problem as a scheduling habit. Debt appears manageable because nobody has demanded payment yet. Then the Great Depression removed the assumptions holding the arrangement together. Workers lost jobs, businesses failed, farm and urban property values fell. Banks and building associations came under pressure as savers demanded cash and borrowers missed payments. Most importantly for the homeowner with a balloon mortgage, new loans became scarce. A balance that had been expected to roll forward suddenly had nowhere to go. The same family that had paid interest reliably could arrive at maturity, ask for a renewal, and hear no. The crisis exposed a brutal feedback loop. A lender refusing to refinance might foreclose, but mass foreclosure pushed houses onto a weak market, depressing prices and the lender's own collateral. Vacant homes hurt neighborhoods and tax revenues. Lower values left other owners with less equity, making their loans harder to renew. Borrowers and lenders were trapped together. A contract designed to contain individual risk amplified it across the economy. Homeownership fell in every region during the 1930s. By 1940, the national rate was about 43.6%, lower than it had been a decade earlier. That decline was not only a story about families who had made reckless choices, it was also a story about the architecture of credit. Short maturities synchronized millions of private deadlines with the worst financial collapse in modern American history. When refinancing stopped, the mortgage system did not merely become expensive. Its basic method of repayment stopped functioning. The federal response did not arrive as one clean invention. It came through a series of institutions that changed different parts of the problem. One of the first was the Homeowners Loan Corporation, created in 1933. It refinanced distressed mortgages into loans that were dramatically longer and more manageable than the contracts many owners faced. Roughly 1 million homeowners received its 15-year, 5% mortgages between 1,933 and 1,936. The program was relief, but it was also a demonstration. A home loan could be restructured around gradual repayment rather than repeated crisis. The Homeowners Loan Corporation often compensated creditors with government-backed bonds and replaced old debt with a standardized loan. A lender might prefer a reliable bond to the uncertain proceeds of foreclosure. The government did not make loss vanish. It reorganized claims so a household gained time, a creditor gained a dependable asset, and a neighborhood avoided another forced sale. Time became an instrument of stabilization. Next came the Federal Housing Administration in 1934. The FHA did not simply lend government money to every buyer. Its central tool was mortgage insurance. A private lender could make a qualifying loan, pay an insurance premium, and receive protection against specified losses if the borrower defaulted. That guarantee changed the lender's calculation. A larger loan, a longer term, and regular principal repayment became less frightening when part of the default risk was pooled through a federal program. The change was gradual, and the dates matter. The original 1934 framework generally capped insured loans at 80% of value and 20 years, with full amortization. In 1938, selected loans could reach 90% of value and 25 years. Broad FHA authorization for 30-year loans arrived in 1954, and adoption was not instant. Many FHA loans made even in 1955 still ran for 25 years. The familiar 30-year mortgage did not spring fully formed from one law. Federal insurance kept widening the space in which long-term, high-ratio, fully amortizing loans could become normal. Amortization transformed the household's experience. Each monthly payment now contained interest and principal. At first, most of the payment went to interest because the outstanding balance was large. Over time, the interest portion shrank and the principal portion grew. There was no giant scheduled balloon waiting at year 5. If the borrower followed the contract, the mathematics itself led to ownership. The loan no longer assumed that another lender would rescue the borrower at maturity. Standardization was as important as duration. To qualify for insurance, loans, appraisals, construction, and servicing had to fit uniform rules. Standard contracts were easier to compare and trust. A mortgage looked less like a private handshake with one local bank and more like a recognizable financial product. That reduced uncertainty but gave standard-setting institutions enormous power to decide which properties, neighborhoods, and people counted as acceptable risks. In 1938, the government chartered the institution that became known as Fannie Mae to buy FHA-insured mortgages. This attacked another constraint. A local lender that made a 20-year loan might otherwise wait decades to recover its principal. If it could sell the mortgage, it could replenish its cash and make another loan. Capital collected in one region could move into housing in another. The secondary market separated the act of originating a mortgage from the need to hold it until the final payment. That separation sounds technical, but it changed what a neighborhood bank could promise. Without a buyer, every new mortgage locked up local funds for years. With a secondary market, the lender could turn future payments into money today. The government was manufacturing liquidity, making a decades-long household promise usable as a present-day financial asset. The Second World War interrupted civilian construction, then created pent-up demand. Service members returned, families formed, and builders looked beyond crowded cities. The GI Bill added a Veterans Administration loan guarantee for eligible veterans, often supporting low down payments and favorable terms. FHA and VA guarantees, mass construction, highways, and suburban land produced an expansion impossible under the old half-down, 5-year balloon model. By the 1950s, the long-term, fixed-rate, fully amortizing mortgage had become the dominant expectation, while 30-year terms spread gradually. Homeownership rose from about 43.6% in 1940 to 55% in 1950, then above 60% by 1960. Rising incomes, savings, construction, demography, and public investment all mattered, but the mortgage contract was essential. It turned a house from an asset demanding accumulated wealth into one purchased largely with expected future income. That sentence contains both the triumph and the danger of the system. The long mortgage widened access because a family no longer needed half the price on closing day. Stretching repayment lowered the required monthly payment for any given loan balance, yet lower monthly payments also allowed buyers to bid more for the same property. When credit expands faster than the supply of homes, part of the benefit is captured in higher land and house prices. finance can make a given price affordable while helping that price rise. Long duration redistributes risk. The borrower escapes the 5-year balloon and, with a fixed rate, future market rate increases. The investor accepts the risk that rates or inflation will rise, while the mortgage pays an old return. The borrower can often refinance when rates fall, but keep the loan when they rise. That option benefits the household and costs the mortgage owner. Insurance and secondary markets made those risks easier to pool and transfer. The down payment also changed meaning. Under a 50% loan, borrower equity protected the lender. Under a 90% loan, the federal guarantee helped substitute for it. This brought ownership within reach of households able to support monthly payments but lacking a fortune. Yet higher leverage meant that a small price decline could erase buyer equity. The system lowered the barrier to entry while making households more sensitive to prices. A 30-year schedule lowers the payment by spreading principal over 360 months, but it can increase total interest. Early payments build equity slowly. Selling after a few years can leave less principal reduction than expected, especially after transaction costs. Ownership is not automatically superior to renting everywhere. The mortgage enables a long holding period. It cannot guarantee a profitable investment, a nearby job, or a sound roof. There was also a profound injustice inside the mid-century success story. The institutions that broadened credit did not broaden it equally. Federal underwriting standards treated neighborhood racial composition as a measure of financial risk. Private lenders, appraisers, real estate boards, zoning systems, and racially restrictive covenants reinforced segregation. Areas with black residents were frequently assigned the lowest grades or denied conventional mortgage capital, while new white suburbs received the safest ratings and the easiest flow of insured loans. The history is sometimes compressed into the claim that one agency drew a map and created redlining. The reality was more layered and no less damaging. Discrimination existed before the New Deal. Homeowners Loan Corporation maps documented and reflected discriminatory assumptions. FHA underwriting rules and private market practices helped institutionalize and extend them. Restrictive covenants kept many buyers out even when they could pay. Federal support lowered risk for approved borrowers, while the definition of an approved borrower was constructed around race and place. Many black families and other excluded households were forced to remain renters or seek inferior forms of finance. In some cities, buyers used installment contracts that offered the responsibilities of ownership without the legal protections of a conventional mortgage. Missing a payment could mean losing the house and the equity already paid. Meanwhile, families admitted to FHA or VA-supported suburban markets accumulated an appreciating asset on favorable terms. The mortgage system did not merely divide owners from renters. It helped create unequal paths of intergenerational wealth. In 1948, the Supreme Court made racial covenants unenforceable by state courts, but private discrimination continued. The Fair Housing Act of 1968 later prohibited major forms of housing discrimination, yet law could not instantly reverse decades of unequal access and missed appreciation. Celebrating the long mortgage as a machine for mass ownership requires asking who could use it, whose neighborhood was lendable, and whose income was trusted. This matters because a mortgage is an admission ticket to a leveraged asset. If a buyer puts 10% down and the home rises 10%, the increase roughly equals the original equity before costs. Leverage magnifies gain and loss. Families excluded during decades of rising prices missed not just a home, but subsidized leverage, predictable payments, and an asset that could fund education, a business, retirement, or an inheritance. The post-war system also changed builders. A standardized, insurable mortgage made it easier to construct for a large market of similarly financed buyers. Developers built entire subdivisions knowing qualifying families could obtain long-term loans. Standardization reduced costs and increased scale, but encouraged uniform development and dependence on cars, roads, and new infrastructure. Mortgage economics reshaped metropolitan America. It changed politics as well. Once millions carried long fixed-rate loans, rates, inflation, taxes, zoning, and house prices became personal. Owners benefited when scarcity lifted values, even as entry grew harder for the next generation. Local restrictions protecting property values could conflict with broad ownership. The long mortgage solved financing for many households, but could not manufacture well-located land or enough new homes. The old system and the modern system therefore ration housing in different ways. The old system asked, how much wealth do you already have, and can you find another lender when this short loan expires? The modern system asks, can your future income support a standardized payment, and does the property satisfy the rules of the market? The first favors accumulated cash and local relationships. The second favors stable, documented income, approved collateral, and access to institutions. Neither is neutral, because every underwriting rule chooses which risks count and who must bear them. It is tempting to describe the 30-year mortgage as a simple victory of progress. Cruel, short loans disappeared, sensible, long loans arrived, and a nation of renters became owners. That version misses the economic bargain. The modern mortgage required the government to ensure credit risk, create a secondary market, standardize appraisal, and stand behind institutions that could move capital across time and space. It also required investors willing to accept decades of payments and a legal system capable of enforcing millions of similar contracts. In return, households gained something genuinely revolutionary. They could match the cost of a durable asset to the income earned while using it. A house provides shelter for decades, so financing it over decades can make more sense than demanding repayment in 5 years. The monthly payment connected a family's working life to a gradually growing ownership stake. Instead of saving for most of the house before moving in, the buyer could move in first and save through principal payments afterward. But the contract also tied families to debt for longer than any earlier generation would have considered normal. A 30-year mortgage can outlast jobs, recessions, marriages, and plans. It encourages buyers to treat distant income as available today. It enlarges purchasing power, which can enlarge prices. And because the system depends on confidence in future payments, a national mortgage market can transmit shocks far beyond the town where a house stands. The tools that spread risk can also connect risks that once remained local. This is the deeper lesson of the balloon mortgage crisis. Financial innovation rarely destroys risk. It changes its timing, its owner, and its visibility. The pre-depression borrower saw the risk clearly at maturity, when the balloon arrived and refinancing failed. The modern borrower sees a smoother monthly path, while interest rate risk may sit with a bank, pension fund, government agency, or investor far away. Smoothness for one balance sheet is often complexity somewhere else. If a buyer from 1927 could inspect a modern closing statement, the number of pages would be bewildering, but the core promise would seem almost magical. The buyer can bring a relatively small share of the price, lock an interest rate, repay principal a little at a time, and know the date on which the balance will reach zero without asking another lender for permission. What feels routine to us would look like protection from the most frightening feature of the old world, the sudden demand to pay for the house again. And if a modern buyer could inspect the older contract, the low monthly interest might initially look affordable. Only later would the trap become obvious. The payment is low because the debt is not going away. The family has rented the money, not purchased it over time. At maturity, its ownership depends on cash, a sale, or another loan. The old mortgage did not end with a final small payment. It ended with a negotiation. That is why the economics of owning a home before 30-year mortgages was really the economics of access to refinancing. Saving mattered, income mattered, the building mattered. But the decisive variable was whether credit would be available at the exact moment the old note came due. During prosperity, that dependency hid behind routine renewals. During the Depression, it became a national emergency. The failure was not only that people could not make payments, it was that the system demanded a kind of payment it had always assumed the next loan would provide. The institutions built in the 1930s and 1940s replaced that dependency with a different promise. Government insurance absorbed part of the default risk. Standardization made loans legible. Fannie Mae helped turn mortgages into assets that could be sold. VA guarantees widened, favorable credit for eligible veterans. Longer terms aligned debt with household income. Together, these changes converted the mortgage from a short local bridge into a national financial infrastructure. That infrastructure helped millions of families own homes, stabilized communities, and supported an enormous construction economy. It also privileged some borrowers and places, excluded others, increased leverage, and helped turn house prices into a central measure of household wealth. Its achievements and injustices are not separate stories. They are consequences of the same power, the power to decide whose future income can be transformed into purchasing power today. So the 30-year mortgage did not make a house cheaper in any physical sense. It did something more subtle. It changed when the buyer had to produce the money, who carried the risk while waiting, and how confidently the entire financial system could treat future payments as an asset in the present. It transformed time and household income into collateral. A century ago, the most important date in a mortgage was the day the lender could demand the balance. Today, it is the distant day the scheduled balance finally reaches zero. Between those two dates lies the creation of modern American homeownership, not the invention of the house, not even the invention of borrowing, but the invention of a system willing to wait 30 years to be repaid and powerful